Good morning and welcome back to Pressure Point Economics. You blinked and gold just dropped $500 in minutes. Silver crashed 31% in a single session. The worst day for precious metals since 1980. Wall Street is calling it a blow-off top. The crowd that was screaming $6,000 gold last Thursday is now silent. But here's what nobody wants to say out loud. The fundamentals that drove gold from 2,800 to 5,500 didn't disappear overnight because of a Fed chair nomination. This is not capitulation. This is market structure getting squeezed like a lemon. And when you understand the mechanics of what just happened, you'll see why this crash might be the most important buying signal of the decade. Stay with me because there's one signal hiding in plain sight that could decide everything. Welcome back. It's January 31st, 2026. And I'm breaking down the most violent precious metals reversal in 46 years. Today, I'm going to do two things for you. Thing one, I'm going to dissect what actually happened on January 30th when gold collapsed 11% and silver plunged 36% in what CNBC called the worst single-day decline since March 1980. Thing two, I'm going to connect this crash to the bigger macro setup and show you exactly what comes next, what price levels to watch, and why this could be your last chance to position before the real move begins. This is not about headlines. This is about mechanics. This is about understanding that when market structure breaks, the underlying fundamentals don't just vanish. And if you stick with me through this breakdown, you'll understand why Goldman Sachs, JP Morgan, UBS, and Deutsche Bank are still projecting gold between $5,400 and $6,200 by year-end 2026, despite this crash. If you get value here, hit subscribe. It helps more than you think. Now let's talk about what's actually happening in the metals market right now, because the story you're hearing on financial television is dangerously incomplete. On January 30th, 2026, gold futures fell as much as 12% in a single session, dropping from above $5,500 per troy ounce to below $4,900. That's a $600 intraday swing. Silver got absolutely demolished, plummeting 36% at its worst, settling down 31.4% at $78.53. This was silver's worst day since March 1980. Copper, which had just hit all-time highs above 14,500 per ton, reversed hard and tumbled. The Bloomberg headline called it discovering gravity. But that's lazy analysis. Gravity doesn't explain why COMEX warehouses saw 33.45 million ounces of silver withdrawn in the first week of January alone. That's 26% of eligible inventory in 7 days. Gravity doesn't explain why gold ETF holdings surged to record levels in the week before the crash, with investors pouring $58.5 billion into precious metals exposure. When you do the math, this wasn't gravity. This was coordinated liquidation triggered by a single headline. President Trump announced Kevin Warsh as his nominee for Federal Reserve Chair to replace Jerome Powell. The market interpreted Warsh, a former Fed governor known for hawkish inflation views, as a signal that rate cuts are off the table and dollar strength is back on the menu. The dollar index surged 0.9% on its biggest one-day gain since July. And because metals are priced in dollars, a stronger dollar makes gold and silver more expensive for international buyers, which theoretically reduces demand. But here's where it gets interesting. The DXY dollar index is still down over 10% from its highs last year. It's sitting around 96.5 after this rally. That's nowhere near the dollar strength we saw in 2022 when gold was trading at 1,700. So why did metals crash harder now than they did back then? The answer is leverage and positioning. Now here's the first cliffhanger. The crash wasn't driven by fundamentals changing. It was driven by market structure collapsing under the weight of speculative excess. I'm going to show you the exact mechanism in a minute, but first you need to understand the supply side, because this is where people get lazy. Now let's talk about the supply side, because this is where people get intellectually dishonest with themselves. They see a price crash and assume the bullish thesis is dead, but supply and demand don't move at the speed of headlines. They move at the speed of geology and industrial production. Let's start with gold. Global gold mine production has been essentially flat for 4 years. According to data from Metals Focus, mine output in 2025 was around 3,600 tons. That's barely up from 3,500 in 2022. The easy gold has been mined. New discoveries take 7 to 10 years to bring online, and capital expenditure and exploration has been anemic since 2015. Meanwhile, central bank demand, which is the real driver of this bull market, hit 585 tons per quarter in late 2025 and is projected to remain at that level through 2026, according to JP Morgan. That's central banks buying 2,300 tons annually. To put that in perspective, annual mine supply is 3,600 tons. Central banks alone are absorbing 64% of new supply. And they're not buying because they think gold is going to crash. They're buying because the dollar's role as the world's reserve currency is being openly questioned. Now let's talk about silver, because this is where the story gets absolutely wild. Silver has a structural supply deficit that makes copper look balanced. Industrial demand for silver, driven by solar panels, electric vehicles, and AI data centers, hit record levels in 2025. According to data from the Silver Institute, industrial silver demand was up 18% year over year. Solar alone consumed 210 million ounces. EV production used another 90 million. And here's the kicker. AI data centers, which require silver for high-performance conductors and thermal management, consumed 110,000 tons in 2025. Analysts project that figure will surge to 475,000 tons in 2026. That's a 433% increase in 1 year. Meanwhile, silver mine production declined. Total mine output fell 2% in 2025 due to strikes in Peru and Mexico and depleting ore grades in major mines. Recycling couldn't fill the gap. The result? A supply deficit of over 200 million ounces. That deficit has to come from somewhere, and it came from COMEX inventories, which dropped 117 million ounces from September through January. Think of this like a leaky bucket. You're draining water faster than you're filling it. At some point, the bucket runs dry. The silver lease rate, which is what it costs to borrow physical silver in London, spiked to extreme levels in late January as shortages intensified. That's not speculative froth. That's physical tightness. So when silver crashed 36% on January 30th, it wasn't because the supply-demand story changed. It was because leveraged speculators got margin called and had to dump futures contracts, regardless of the underlying fundamentals. Comment what time you're watching this right now. I read those. Now, quick history lesson, because cycles rhyme, they don't repeat. The January 30th crash is being compared to March 1980, when silver collapsed from $50 to below $11 in a matter of weeks after the Hunt brothers' corner was broken. But that comparison is intellectually lazy. In 1980, the Hunt brothers were trying to manipulate the market with leveraged speculation. They controlled an estimated 1/3 of global silver supply through futures contracts. When COMEX raised margin requirements, they couldn't meet the calls, and the whole scheme imploded. The crash was a liquidation of a fraudulent corner. That's not what's happening now. Yes, speculative positioning in silver was extremely elevated in January 2026. Open interest in silver futures was at multi-year highs, but the difference is this. In 1980, industrial demand for silver was modest. Today, industrial demand is structural and growing. Solar, EVs, and AI aren't going away. The Hunt brothers were speculators. Today's buyers include Sprott, JP Morgan's physical desk, and sovereign wealth funds accumulating for long-term strategic reasons. Let's compare this to 2011, the last major precious metals peak. Gold hit 1,900 in August 2011, then crashed to 1,200 by December 2015. That crash was driven by the Fed signaling rate hikes, the dollar surging, and speculative froth in ETFs unwinding. But here's what's different now. In 2011, central banks were net sellers of gold. Today, they're the biggest buyers. In 2011, the dollar index was rallying into the 90s. Today, it's at 96 after losing 10% in the past year. In 2011, inflation was cooling. Today, inflation is structurally embedded due to deglobalization, energy transition costs, and fiscal dominance. The 2011 crash was the end of a cycle. The January 2026 crash is a pause in a cycle that's just getting started. Here's the second cliffhanger. Those spikes in 1980 and 2011 had one similarity. Crowd belief turned into crowd certainty. When everyone's bullish, when retail is piling in, when your barber is talking about silver squeeze, that's when corrections happen, and that's exactly what we saw in late January. Silver squeeze became a meme. Gold to 6,000 was consensus. And then Warsh got nominated, margin requirements got hiked, and the weak hands got flushed. But the strong hands, they're still holding. Here's where we separate position building from event chasing, because if you don't understand this distinction, the market is going to rip your face off. If you're event chasing, you're vulnerable. The market can smell it. You buy because price is ripping. You panic when it crashes. You have no thesis. You're trading momentum, and momentum is a cruel mistress. She abandons you the moment you need her most. Position building means you're okay if price drops tomorrow, because you understand the fundamentals are playing out over quarters, not days. Let me give you 4 questions to evaluate whether you're positioned or just gambling. Question 1. Do you understand why you own the asset, independent of what price did last week? If your answer is because it's going up, you're event chasing. If your answer is because central banks are diversifying away from dollars, because supply is constrained, because fiscal dominance means real rates stay negative, you're position building. Question 2, can you articulate what would invalidate your thesis? If you can't, you're not thinking, you're hoping. For metals, invalidation would be central banks reversing and becoming net sellers, or a genuine deflationary collapse where credit contracts faster than money printing. Neither is happening. Question 3. Are you sizing your position so a 30% drawdown doesn't force you to sell? If you're all in, you're gambling. If you're holding 5 to 10% of your portfolio in metals and you're comfortable with volatility, you're building. Question 4. Are you waiting for certainty or are you buying uncertainty? If you wait until everyone agrees, you're going to be late. The edge in markets is doing what's uncomfortable when it's uncomfortable. In December 2025, buying silver at $31 felt dumb. It had already doubled from 21. Everyone said it was overbought. By January 26th, it hit 121 and everyone said it was going to 150. That's the exact moment you should be taking risk off, not adding. And now, after a 36% crash, when everyone's calling it a bubble pop, that's when you build, if the math still works, which I'm about to show you it does. For deeper analysis and real-time updates on what I'm watching, check the membership link below. I send voice notes daily when things get spicy like this. Now let's get technical for a minute because chart structure matters, and right now metals are sitting at a critical inflection point. Gold topped at 5,593 on January 29th, then crashed to a low of 4,870 on January 30th. It's currently consolidating around 5,000. That 5,000 level is now the battleground. If gold holds above 5,000 on a weekly close, this crash is a bear trap and the bull trend resumes. If it breaks below and closes a week under 4,800, we could see a deeper correction toward 4,200, which is the 50% Fibonacci retracement from the November 2025 low of 2,800. But here's the key. Even at 4,200, the bull market is intact. The 200-day moving average for gold is around 3,900. As long as price stays above that, the trend is UP. Now let's talk about silver because this is where it gets wild. Silver peaked at 121 on January 29th. It crashed to 78.53 at the lows. That's a $42 move in one day. It's currently around $99. The critical support for silver is $85. That was the breakout level from earlier in January. If silver holds 85, this is a shakeout and the squeeze resumes. If it breaks, we could see a flush back to 70 or even 65, which is the prior resistance from December. But here's what you need to understand. Silver's correction is steeper than gold's because silver has more speculative leverage. The gold-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, spiked from 46 to 63 in one day. That's a massive move. Historically, when the gold-silver ratio spikes above 60, it creates an asymmetric opportunity in silver. Because silver's industrial demand is structural, but its price is getting hammered by speculative liquidation. That's a mismatch. Market structure analysis shows this crash was driven by margin hikes and forced liquidation. COMEX raised margin requirements for silver futures by 15% on January 28th. That forced over-leveraged traders to sell into thin liquidity. ETF flows turned sharply negative. iShares Silver Trust saw outflows of $200 million on January 30th alone. But here's the thing. Physical premiums widened. Retail silver coins and bars are trading $4 to $6 over spot. If this were a genuine demand collapse, premiums would compress. They're not. That tells you this is a paper market flush, not a physical market rejection. Based on supply deficits running 200 million ounces annually, structural industrial demand growing, and central bank gold buying remaining at 585 tons per quarter, the math is probability weighted toward gold reaching 5,400 by Q4 2026 and silver recovering to 135. Goldman Sachs just raised their year-end target to 5,400. UBS is at 6,200. JP Morgan is at 5,500. Deutsche Bank says 6,000. These aren't permabulls. These are the biggest banks in the world revising UP after the crash. Now let's zoom out to the bigger macro setup because metals don't trade in a vacuum. They trade as a function of real interest rates, dollar strength, fiscal dominance, and geopolitical risk. Let's break it down. Real interest rates, which are nominal rates minus inflation, are the primary driver of gold. When real rates are negative, meaning inflation is higher than the interest you earn on bonds, gold becomes attractive because it preserves purchasing power without counterparty risk. Right now, the Fed funds rate is 3.5 to 3.75%. Core PCE inflation, the Fed's preferred measure, is running at 2.8%. That means real rates are positive by about 70 basis points. But here's the key. Fiscal dominance. The U.S. government is running deficits of $2 trillion annually with debt to GDP at 124%. Every 1% increase in interest rates adds over $350 billion in annual debt service costs. The government cannot afford sustained high rates, which means the Fed is trapped. If they hike to fight inflation, they blow up the deficit. If they cut to ease financial conditions, they risk inflation reaccelerating. That's called fiscal dominance, and it's the reason gold will outperform over the next decade regardless of short-term volatility. Now let's talk about the dollar. The DXY surged on January 30th after the Warsh nomination. But let's zoom out. The dollar is down 10% from its highs. Why? because Trump has explicitly said he wants a weaker dollar to boost exports. His Treasury Secretary nominee has echoed that. Meanwhile, China and Russia are settling trade in yuan and rubles. BRICS nations are exploring alternatives to dollar-based payments. Saudi Arabia is signing oil deals denominated in yuan. This isn't conspiracy. This is policy. The dollar's reserve status is being eroded intentionally by U.S. fiscal recklessness and deliberately by rival powers. When the dollar weakens structurally, gold and silver rise. Not in a straight line, but over time. Geopolitical risk is another accelerant. The Russia-Ukraine war is unresolved. Middle East tensions remain elevated. U.S.-China relations are adversarial. Taiwan remains a flashpoint. Every one of these risks drives safe haven demand for gold. And here's the thing. Central banks in the global south are buying gold, not because they think it'll make them rich, but because they don't trust the dollar. That's a strategic shift, not a tactical trade. When Turkey, India, China, and Brazil are buying hundreds of tons, that demand doesn't reverse because Kevin Warsh got nominated. Now let's talk about risk assets, because they're signaling something important. The stock market has been choppy. The S&P hit 7,000 but failed to hold. Bitcoin crashed from 108,000 to 82,000. Credit spreads are widening slightly. Volatility is ticking up. These are signs that confidence is fragile. And when confidence is fragile, gold benefits. This doesn't happen overnight, but here's the realistic timeline. Expect chop and consolidation through February and March as the market digests the Warsh news and assesses Fed policy. If gold holds 5,000 and silver holds 85, we get a resumption of the uptrend in Q2. By Q3, if central bank buying remains strong and dollar weakness resumes, gold tests 6,000 and silver makes a run at 150. That's the base case. The bearish case is gold corrects to 4,200 and silver to 65 before rebasing. The bullish case is this crash was the flush and we rip faces off by April. Here's where the edge is, and if you're still with me, this is the part that matters. The edge is understanding what Wall Street is missing in this data. They see a crash and assume the trend is broken. They see margin liquidation and call it a top. But they're ignoring three things. Thing one, physical markets are tight. COMEX silver inventories are at multi-year lows. Gold premiums in Asia are elevated. Retail coin demand hasn't collapsed. If this were a top, physical would be flooding back. It's not. Thing two, central bank buying hasn't stopped. China, Turkey, India, and Poland added to reserves in December and January. That data lags, but when it's reported, it'll show continued accumulation. That's the smart money. Thing three, industrial silver demand is accelerating, not decelerating. AI data center builds are ramping, solar installations are growing, EV production is expanding. None of that stopped because silver crashed from 121 to 78. The crowd is focused on price. The edge is focused on flows, and flows are still bullish. What's being ignored is the asymmetry. If you buy gold at 5,000 and it goes to 4,200, you lose 16%. If it goes to 6,200 like UBS says, you make 24%. If you buy silver at 99 and it goes to 65, you lose 34%. If it goes to 135, you make 36%. Risk reward favors the bulls if you can handle the vol. Now let's talk positioning. Contrarian positioning means you do the opposite of the crowd at extremes. In late January, everyone was bullish. Positioning was crowded. Now sentiment has collapsed. Retail is scared. Weak hands are out. That's typically when smart money accumulates. I'm not saying go all in. I'm saying if your thesis is intact and the math works, this is where you build, not abandon. Personal psychology check. If you can't handle 3-day dips of 10%, this sector will chew you up and spit you out. Metals trade like a boxer. They lumber, they feint. Then they throw a hook when you're not looking. The January 30th crash was the feint. The hook is coming. But you have to be in the ring when it lands. So what does this mean for you? Let's break it down by time frame because clarity matters. Short term, next 2 to 4 weeks. Watch 5,000 in gold. If it holds on a weekly close, we're in a bull flag and the next leg targets 5,400. If it breaks, expect a retest of 4,800 or even 4,200. For silver, $85 is the line. Hold it and we consolidate, then rip. Break it and 65 to 70 is in play. Also watch the dollar. If DXY rolls over from 96 back toward 93, that's fuel for metals to rally. If it breaks above 98, we get more pressure. Medium term, next 3 to 6 months. This is where the bull case reasserts. Central bank demand remains robust. Supply deficits persist. Fiscal dominance ensures the Fed can't hike sustainably. If we're right, gold tests 5,400 to 5,800 by June. Silver retests 120 and tries to break toward 135 to 150. The key levels are the prior highs. Gold 55.93 and silver 121. Breaking those confirms the trend. Failing at them twice could mean a longer base. Long term, 6 to 12 plus months. The ultimate targets are unchanged. Goldman, UBS, JP Morgan, and Deutsche Bank all see gold between 5,400 and 6,200 by year end. Some are projecting 8,500 longer term if central bank buying accelerates. Silver's target is 150 to 180 based on supply deficits and industrial demand. These aren't moonshot predictions, they're math-based projections grounded in supply demand and macro trends. Risk management. Here's how you don't get killed. Position sizing is everything. Don't bet the farm. 5 to 10% of your portfolio in metals is aggressive but survivable if it corrects. Use physical or ETFs, not leveraged futures unless you're a professional. Getting paid to wait. If you own physical, you don't get margin called. You just wait. The thesis plays out or it doesn't, but you're not forced to sell at the bottom. What invalidates the thesis? Central banks becoming net sellers. That would be a major red flag. Or a genuine deflationary collapse where credit contracts violently. Watch unemployment and credit spreads. If unemployment spikes above 6% and credit spreads blow out, metals could struggle in the short term. Specific stop loss or reevaluation triggers. For gold, a weekly close below 3,900 would break the 200-day moving average and signal deeper trouble. For silver, a close below 55 would break key support and suggest the bull market is over. Neither is likely, but you need to know your exits. Tell me in the comments, do you think gold hits 6,200 before December, or does it pull back to 4,200 first? I want to hear your take. Remember what I said at the start. You blinked and gold just dropped $500. Silver crashed 36%. Everyone's calling it a top. But when you look at the mechanics, this was a margin-driven liquidation triggered by a headline about a Fed chair nomination. It wasn't driven by central banks stopping their buying. It wasn't driven by supply deficits reversing. It wasn't driven by industrial demand collapsing. Let me give you the 3 most important data points to watch going forward. Number 1, COMEX inventories. If silver inventories continue to drain, that's bullish. It means physical tightness is real. Number 2, central bank gold purchases. The data comes out quarterly with a lag. Watch for Q4 2025 and Q1 2026 numbers. If they're still buying 500 plus tons per quarter, the bull case is alive. Number 3, the dollar index. If DXY breaks back below 93, that's the green light for metals to rip. If it rallies above 100, we're in for more pain. The key price levels that confirm or deny the thesis are simple. Gold above 5,000 is bullish. Below 4,800 is caution. Silver above 85 is bullish. Below 70 is bearish. The next phase of this cycle won't send you a calendar invite. Positioning happens in the quiet moments, not the loud ones. Right now, the market is quiet. Sentiment is crushed. Retail is scared. That's typically when the smart money accumulates. I'm not saying this is the bottom tick. I'm saying if your thesis is intact, this is where you build, not where you panic. Market's price consensus, not inevitability. In late January, consensus was gold to 6,000 and silver to 150. Now consensus is calling it a bubble pop. Both are wrong. The truth is in the middle. This is a correction in a secular bull market driven by fiscal dominance, currency debasement, and supply constraints. I'll be tracking COMEX inventories and central bank flows closely. That's the tell. If inventories keep draining and central banks keep buying, this crash will be remembered as the gift. 3 quick things before you go. Thing 1, hit subscribe so you don't miss the next move. We're in the middle of a generational shift in monetary systems and you don't want to be caught off guard. Thing 2, drop a comment sharing your take. Are you buying this dip or waiting for more confirmation? What's your target for gold and silver by year end? I read every single comment and your insights help shape the content I create. Thing 3, join my premium WhatsApp channel for daily voice notes and instant updates when things move fast like they did on January 30th. I break down positioning, flows, and what I'm watching in real time. Link is in the description, and we're doing a giveaway at month's end for subscribers who comment. You're automatically entered just by engaging. This is not financial advice. Do your own research. Consult a qualified professional before making any investment decisions. I'm sharing my analysis and framework, but your money is your responsibility. I'll see you in the next one.